Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week you learn how to invest wisely and safely. This week's episode is all about the net numbers. Some people call it the net profits. I've heard other people call it the net, but really what we're talking about is what is your true income? And you have to look at the net number. So not just what you see on, say, Rentometer, for example. But I don't want to spoil it too much. Adam, what are your thoughts on this?
Yeah, it's interesting to me that a lot of times you'll hear people hype up things like investing in real estate or, owning rentals, and they'll talk about m- all these numbers in terms of how much profit they're making, numbers per door, or how much monthly cash flow they're making. And they're not really considering the net or what you get after all expenses, which is really the only way to understand your profit. So, Kevin and I were talking about this and wanted to sort of break that down and tell you some things to look for and how to see through some of the glamorization or the hype of it and look at the real facts and what you'll need to be a successful investor.
Yeah. So from a rental perspective, one thing to think about, I've heard people say, Brandon Turner, for example, the co-host of the Bigger Pockets podcast, he aims to get $100 per door.
Mhm.
And you're thinking to yourself, what $100 per door means? Like, what am I supposed to do with that type of cash flow? Right. And then he breaks down, he put an Instagram post on it. We'll probably link to it in the show notes, but it's an image of all the expenses that are considered, from property management to taxes to the insurance to the debt service, and then walking away with the net profit of $100. So those expenses, a lot of the times, often get overlooked. And Adam, from your perspective as a owner of a few rentals, I'm sure that you've seen, oh, on Rentometer, I can get 1,100 for this, but that 1,100 for you charging for rent isn't what you're actually taking home.
Right. Not at all. And if you're investing smartly, you're leveraging your property. You're using other people's money to finance the property. And one of those other people is the bank. And right now, money's on sale. It's unthinkable how cheap you can get banks capital for an investment property. So smart people are getting as much of that as they can to finance the deal, and you have to pay that monthly debt service payment. So that takes a big chunk of that amount out, right? So that's a big expense. A lot of people do account for that, but there's some that are almost invisible costs that people don't think about, especially inexperienced investors or people who are new. They just don't think about things like accounting for your capex. It's important that you do account for big expenses that you're going to have on this property if you own it for a long time. So if you're talking about owning a property for 30 or 40 years, one day you'll have to put a roof on that, or you'll have
Yep.
to replace the entire HVAC system, or you'll have to put a driveway in. Almost no one thinks about that. I did all three of those things on one of my rental properties. And they're things you're going to have to do. So in order to have enough money to be able to pay for those things, you need to be accounting for them and saving a little money each month in an account for that so you can pay for that stuff. Are there other things
Yep.
that you think of, Kevin?
Well, one thing is property management. You know, that I think the going rate might be somewhere around 10% of the existing rent. And property management isn't a required thing when you're owning a rental, right? It's convenient. It helps it make it more passive. But let's say you're going to manage it yourself. I think you should incorporate that property management cost when you're doing your analysis, even if you're going to be the one to manage it. The argument there is you should be paying for your time, right? But also, if it shows that you're making a profit with that property management expense already calculated, then what's stopping you from just saying, you know what, I'm tired of kind of managing this. Let me bring somebody else in. And you'd still have a net profit. So you'd be paying for your time, but you'd also be calculating that in if you wanted to just walk away and, let's say, go on vacation or whatever the case may be, to have somebody else do it for you.
Kevin, I wholeheartedly agree. That's really smart thinking because things change. And yeah, you may not mind managing that property right now, but let's say something unexpected happens and all of a sudden it becomes a real pain for you, a big inconvenience. Or let's say you get one too many calls in the middle of the night from some kind of a tenant emergency that's not really an emergency. And you decide, you know what? I'm really tired of this. You want to be able to hire a property manager to take care of that kind of stuff and still profit from the deal. If you haven't factored that in upfront before you buy, then you're probably not going to be able to do that. And you might lose money every month instead of making money every month. So I think that's really smart. Another thing that people sometimes don't think about is utilities. Now, on most single family rentals, tenants will pay the utilities, but not always. On duplexes, though, it's a different story. It depends on the market you're in. If every other unit in the neighborhood has the owner paying the water, for example, then you're going to have trouble renting your unit if you're the only one making tenants pay for the water, or you're going to have to drop your monthly rent to make it competitive. So you should factor that in. Make sure you understand that for the property you're looking at and factor that into the deal. Um, One of the biggest things I think people miss or don't account for is taxes and insurance. They may think about them, but if you don't factor in that the costs are going to be different for you as a new owner, then you could unintentionally be under projecting what you'll be paying. When you buy that property, your taxes are probably going to be a lot higher than the original owner because they probably owned it for a long time. Insurance may also be different. So make sure you factor that in.
Yeah, so get various quotes from the insurance perspective, get competitive quotes from a property management perspective. When you're doing your due diligence and your analysis and you're crunching the numbers, personally, I like to be overly conservative because if it turns out that I was kind of risky with my numbers, then I'm opening up myself for greater downfall, greater potential profit loss. But if you are more conservative and the deal still works, anything more than that is just going to be a cherry on top.
Yeah, I completely agree with that. And the last thing I'll say about rental properties and expenses to make sure that you're accounting for is reserves. Make sure that you're keeping the right amount of reserves for each property. And that's really important. It can be different for the type of property. So do your homework, figure out how much reserves you need, and make sure you are keeping enough money in your bank account for reserves. Now, Kevin, I'd like to ask you about some things that you might consider from a note investing perspective. What things do you think about?
So when I think about from a note investing perspective, the principal and interest that the borrower is paying is not the cash flow you're walking away with, right? That's just what it is. As a lender, you're going to pay for servicing, or that's what I do at least, for a couple of reasons. And for those of you who aren't familiar with it, a servicer, you can think of them analogously to being a property manager, but instead of managing property, they're managing the debt. They're important in certain states where you're required to have a license to collect debt because as a lender, that's what you're doing, right? The borrower or the homeowner is paying you like they would the bank. Therefore, they're paying on that debt and you're collecting payments on that debt. So in certain states, it's required you have some type of licensing or you can use a lender. Now, if you have specific questions about your state, of course, I am not a lawyer nor a legal expert. So please ask your local real estate attorney on the specifics on that. Um, that can be anywhere between 20 to $40. There are things such as taxes and insurance that you should be collecting for as the lender. Because if you leave it up to the borrower to say, hey, we're going to pay for you're going to pay your property taxes, life happens, people forget. And a lot of the times, if you're not collecting that as a monthly basis, when they see that annual check of, oh, I need to pay $5,000 for my property taxes, that might come as like a sticker shock and they may not have it, which can put you as a lender in an unfavorable position. So making sure that the servicer is also collecting for taxes and insurance as well. You can get lender's insurance, that kind of thing, title insurance rather, to make sure that you are protected as the lender in case something was to go awry and in the event of a foreclosure. So those are really the main expenses: the servicing fee, the escrowing, for taxes and insurance are going to come off of the top generally of what's already considered the principal and interest. So sometimes the principal and interest, let's say it's $300, there might be an additional thing that the borrower is responsible for. You have to check the note that it says all that information, that the borrower is responsible for $300 of principal and interest, plus, I don't know, let's say another $50 a month for taxes and insurance. Otherwise, that $300 a month just means that that's what they're paying. And then the servicer may take the additional money that's required for taxes and insurance.
Great information, Kevin. I think that's real information, especially people who are familiar with note investing. Look for that. So appreciate that.
Yeah, no problem. And reserves are also important as the lender. And one thing I'll touch on that too is because any performing note has the risk of becoming non-performing, as we've seen with COVID and the 2020. Right, that year was just kind of a weird year. Industries got wiped out, people's jobs got lost, and you may have to have reserves to pay for the legal fees of going through a foreclosure or having borrower outreach that you're going to have the attorney do. So reserves are important there. You don't want to be buying a $15,000 note and only have $15,000 in your IRA, for example, because you can't really use personal money with an IRA. So just having those reserves readily available as well, like you mentioned, from a rental perspective. So when people talk about, hey, this is what I'm making on this rental, be happy for them, but at the same time, know that that may not be the exact net profit. Just be aware that there's always expenses, from the perspective of looking at it as an outsider in, right? Looking at, what people are posting online, the numbers that they're posting probably aren't the true numbers. And then if you are the active investor and you're in it, looking at the deals and looking at the numbers, remember there are always more expenses than you realize, and it never hurts you to be conservative with your numbers. And if the math doesn't work with as conservative as you are, I think that it's not worth trying to make the numbers work. The numbers should just work or they don't work. But that's my 2 cents. What do you think, Adam?
Yeah, because if you do anything other you said, use numbers.
Well, it looks like
And
Adam's internet has cut out a bit, but we'll go ahead and keep going with this episode. And to Adam's point, yeah, you're not going to hurt yourself by being overly conservative. And look, if you need help with due diligence, or you want us to kind of glance over the deal in front of you, we're happy to help. Just send us an email, techguyswhoinvest@gmail.com. And lastly, if you like the Tech Guys Who Invest podcast, please leave us a review on Apple Podcasts. That way we can get connected to more like-minded individuals like yourself and show everybody the true power of investing. Thanks, everybody.